Welcome to PSE Stock Market Webinar. Our topic this afternoon is building a healthy investment portfolio. So please note that this webinar presentation is for educational and informational purposes only. This should not be construed as a professional, financial, or investment advice or recommendation from the PSE. So before I introduce our guest speaker this afternoon, I would like to share with you a video, a refresher video about stocks. So this will take about 2 minutes. So please watch this.
Filipinos are becoming more familiar with financial investments. Over the years, more and more individuals have started building their wealth by investing in stocks. In 2019, the PSE reported close to 1.23 million stock market accounts, of which 97.7% are represented by retail investors. Two-thirds of retail investors belong to the younger age groups with an annual income of less than 500,000 pesos. Are you thinking of starting your stock investment journey? Here are the things you need to know about stocks. What are stocks? Stocks are shares of ownership in a company. When investors buy shares of stocks of a publicly listed company, they become a part owner of that company. As a part owner, investors become part of the company's growth and future profits. Why should investors consider investing in stocks? Several benefits come from investing in stocks. Stockholders can participate in the ownership of a professionally managed company. They are entitled to participate in the company's important decision-making process and to receive a share in the company's profits. Stockholders can make money in the stock market in two ways. First, through price appreciation when investors buy low and sell high, and second, through dividends when a company distributes a share of its profits to its investors. Stockholders can enjoy the liquidity of their funds. They can buy and sell stocks during trading hours. Stockholders can expect that there will always be transparency in the market. The PSE has a state-of-the-art and fully automated disclosure system called PSE Edge. With its mobile app version, access to information is at your fingertips. How can investors invest in stocks? Investors can start investing in stocks through these 3 steps. 1. Open a trading account. At present, there are 126 active stock brokerage companies you can choose from. Visit the PSE website at www.pse.com.ph and select Directory under Trading Participants to view the complete list. After choosing your stockbroker, you may now open your trading account. Similar to the process of opening a bank account, a representative of your chosen stock brokerage firm will require you to undergo the Know Your Client or KYC process. 2. Fund your account. Start thinking of what stocks you wish to buy or sell and discuss this with your broker. 3. Place your buy or sell orders. You can call or text your stockbroker to place an order to buy or sell. Orders can also be placed directly online via an online trading platform. Now that you understand the basics of stock market investing, you can now start your investment journey to help you achieve your goals.
So there you have it. Short video about the what, why, and how of stock market investing. So back to our webinar. Our guest speaker this afternoon. So he has more than 10 years experience in finance and is currently the Vice President of Philequity Management. So he helps manage the different funds under Philequity. Ladies and gentlemen, please help me welcome Mr. Miguel Agarao. Good afternoon, Miguel.
Good afternoon, John. How are you?
Thank you. And we're glad to have you with us this afternoon.
Thanks for inviting me. Okay, good afternoon, everyone. I think this is the first time I'm giving this via Zoom. I wish I could see everyone in person, but of course, we don't want to get COVID. So first priority, stay safe. As I always tell people, if you just survive this pandemic, you already make a profit. So, let's start with that one. Anyway, my topic today is about building a healthy investment portfolio. And while you can think of this as maybe just buying the right stocks, maybe listening to our rumor gone right, I think what's more important is we understand the logic on how you actually build a portfolio of stocks that you can hold for the long term. So, when I talk to different people, maybe when you talk to your friends, and they'll tell you what's the most important thing that determines how much money you'll make, what's the most important factor that will determine your portfolio return, what is the most important determinant when you pick stocks. You could hear something like, um, it could be picking the right stock, and therefore you're going to make the most money if you pick the stocks that perform the best. Or it could be not just picking the right stock, but buying and selling at the right time. Some people say it's better lucky than good. And honestly, sometimes it is better lucky than good, but you can't really rely on luck all the time, right? And finally, some attribute it to feng shui. There's quite a bunch that is very superstitious in terms of when they buy stocks and what they buy. Now, many of you may believe some of this, part of it, a big chunk of it, but research shows that the single most important determinant for the return of your portfolio, whether it's in stocks, bonds, or cash, property, or otherwise, is asset allocation. More than 90% of an investor's return is determined not by when he buys, not by what stock he buys, but the mix of assets in his portfolio. And this is very important. This is very important to consider because we're all thinking maybe just buy low, sell high, where there'll be a consistent way to make money. But we can all make mistakes as well. But over the long term, there's research on this topic with data spanning more than 50 years. And this is more important than stock picking or timing. Now, since we're talking about asset allocation, you need to know what type of assets you can actually buy, what assets you can invest in or allocate your money to. So the most basic would be cash. You can also put it in a time deposit, so you'll get a little bit of yield instead of the cash just being under your pillow. You can also buy other currencies other than the peso. The most popular would be the US dollar. But you can also buy others like the euro, the Japanese yen, or if you like other Asian countries, the Singaporean dollar, Indonesian rupiah, Chinese renminbi is becoming popular. So there are many other currencies you can also invest in. Then you can also buy bonds. So essentially, you're like buying someone else's debt or utang. So then you get paid the interest. I noticed in the survey, very few of you buy bonds. Well, I think that should be part of your portfolio. I'm going to show you a couple of pictures later on why that will show you that you should not be heavily invested in bonds at this point in time. So there's a very long explanation for that, but I'll try to do it in like a minute or two. For those who love jewelry, the girls out there, whatever your husband says, jewelry, as long as it's not fake, you take care of it well, is still counted as an investment. Yan lang, how much of your husband's money or your own money do you put in that, right? Gold, whether it's in jewelry form or bar form, that's an investment. Paintings, art, that is also an investment. I'm not very good at choosing paintings, but some people are pretty good at that. Real estate, one of the more popular ones. A lot, a house, a condo. There are people who are more entrepreneurial. They want to have their own business. That is also a type of investment. I'm concerned primarily the stock market, so that would be my field of expertise. And finally, mutual funds. So just to show you what I mean by asset allocation as an impact on your return. Like for example, you want to play super safe. No harm actually, but you'll see that the return on a savings account hasn't been very high. All right. Time deposit a little bit higher. Bond safe, but it's about 4+5%. But you'll see the average return over 10 years, the stock market dwarfs that, even with the sharp drops that you've been seeing recently. And then, of course, our mutual fund does better than the stock market. We'll talk about that later. But as you can see here, it's not stock picking, it's not timing. This is a buy and hold portfolio over time. You'll see that asset allocation, again, will have the biggest impact on your return. So now, while asset allocation is the most important, and that's why I wanted to spend some time on that, there are four factors I want all of you to consider when you construct a portfolio for all your assets, be it cash, bonds, property, a business, or the stock market. And this is more important than telling you what to buy actually or when to buy it. Because once you learn these principles, each one of you, and all of you have different personalities, different capital, different needs, different different traits. No one person is the same. Using these four factors here, you will be able to determine the construction of your portfolio and what the asset mix should be, how much you should put in it, etc., etc. Now, I'm not a financial planner, but you can say this is like a financial planner-ish type of thing, but I just want to guide all of you. So asset allocation is by far the single most important. But the second one is diversification. As they say, don't put all your eggs in one basket. That's cliche. I'm going to explain that later. Third is risk tolerance. And fourth is time horizon. So whenever you make an investment in deciding when or what to buy, these four things should be taken into consideration. And I just want to go through them briefly one by one. I don't want to have a very long presentation because I think more time is better spent on Q&A. So, the difference is because I can't see you guys. I can't answer questions or look at your facial reactions as things happen. So better if I spend more time on the Q&A. Now, I was telling you earlier that, this is not the time to be in bonds. And I just want to show it with this chart. I'll just use two charts to explain it. This is the chart of the bond yield of the benchmark US 10-year Treasury. So for those who are not very familiar with bonds, if this is going up, that means the price is going down. Because typically bonds are priced on yield. The bond stocks, they're pinaprice sila based on the price you can buy and sell. Typically in the bond market, it is priced based on, when you say yield, the interest rate you get on the bond. So here you'll see that from a low of 0.31% during the COVID outbreak, bond yields have got to 1.4 2 weeks ago. Actually, last night it's already hit 1.7%. And what this tells you is the bond bull market, where bond yields kept going down and therefore prices kept going up, it looks like that bond bull market is finally over. So in the past, I'd say 7 to 10 years, bondholders were really raking it in. Malaki kinita nila dyan relative to the stock market. And considering that it was kind of risk-free if you buy the right bonds. But I think that show is finally over. In the US, one crucial line was this, the S&P 500 dividend yield. When this broke 1.5%, okay, it meant that bond yields are already starting to get more attractive than the stock market's dividend yield. But at the same time, that meant that your bond prices fell a lot. At some point, when this yield is high enough, it's going to be attractive to get into bonds. But I think this has some ways to go. Meaning if you're holding a bond that is being marked to market or that you won't hold till maturity, you may actually lose money in the coming months and years. To put it in a Philippine perspective, I'll show you the 10-year Philippine bond. This was as low as about 2.6% and yield, and it has now creeped up to about 4.4%. So you may think, 4.4% a year is not bad. But I just want to remind everyone, when you make an investment, the bare minimum return over the long term that you should have is inflation. And right now, the February inflation number is 4.7%. So if you buy the 10-year bond of the Philippines, even if you're making 4+% a year on that, you're still losing like 0.3% of your money every year because it's still below the inflation rate. So either that inflation rate goes down or bond yields go up. And looks like in the next 3 to 6 months, the inflation rate's likely not going to go down, and this one's likely going to keep moving up. So there will be a time, and this is worth it, like over here, 8% a year, holy cow, that's worth it, even for a stock market guy like me. But 4%, maybe not so much. Now, I don't know how many of you have financial advisors, but all of you seem, I think majority of the people here are fairly experienced, and you're going to hear something when you look at your so-called portfolio composition, or when you buy other balanced funds, that the mix of the portfolio should be 60-40, meaning 60% of the portfolio is in bonds, 40% is in stocks. You'll also hear that for every year of your age, that should be how much of your portfolio should be in bonds. So hypothetically, if you're 30 years old, 30% bonds, 70% stocks. If you're 80 years old, 80% bonds, 20% stocks. Now, these are things we commonly hear, but if you take a step back and ask yourself, is there really real basis behind that mix? I mean, if you look at all the balanced funds in the country, they are all roughly 60-40. But is 60-40 the proper mix for everyone all the time? So that's a question mark. So like, for example, if your bond yields are like 2%, why would you want to have 60% of your portfolio in bonds? Now, this in contrast, if bond yields are 10% or 15%, then maybe 60% is like, whoa, maybe 10% a year guaranteed, not so bad, right? So actually, with your bond yields going up, but still very low, meaning your bond prices are still falling, I think in the next few years, you're going to see the end finally of the 60-40 portfolio. And that this 40% in stocks may have to go up in order to give you a return that is above the inflation rate. So that's the bare minimum return you should aim for, above the inflation rate. So the general rule, and again, the numbers here really depends per person. The younger you are, the more risk you should take. You can be young at heart, like some people, even though they're really old, they can YOLO the stock market. And I think in the survey, most of you were like under 40. And I think there was no 60-plus-year-old person on the Zoom, at least. I think in Facebook there was, but looks like most of the people watching on Zoom are the young techie ones. Anyway, the earlier you start, the better. Okay, so you need to invest earlier so your money can start earning earlier, and therefore you will earn more. And I cannot emphasize that enough. So the earlier you start, the better. But before you can invest, you must first save. So save, then invest. If you do not save, you cannot invest unless you like ask money from your parents or something, or you have an inheritance. And that over time, if you keep your returns invested in the market, you can compound your returns, and this will dramatically increase how much money you'll make. This will dramatically increase your portfolio value and net worth. And over time, because of the way compounding works, the longer you stay invested, the more money you're going to earn via the compounding mechanism. Now, I know a lot of you probably buy stocks individually, and maybe you watch the market very regularly, and there may be other assets that you want to look into. But I just want to remind everyone, even if you make money on something, investment is not the same as speculation, okay? When you go to the casino and you double your money on the slot machine or the baccarat table, just because you make money does not mean going to the casino is an investment, okay? That's gambling. So just, there's a difference. So, the end does not mean that's what you're doing, because over time, the casino will win, right? And the same goes with speculation. Unless you like have mega insider information and a crystal ball, you're probably going to end up losing more money than you'll make if you're trading very speculative stocks that are driven by rumors. So I just want to highlight, your goal is to invest. Bulk of your money should be an investment. If you want to speculate, do not convince yourself it's an investment. You are actually gambling, and you've got to be honest with yourself. How much money am I willing to gamble? Okay, because you can invest in something higher risk, but it's not a gamble. Like stocks are higher risk than bonds. So there's nothing really wrong with that. Differs person to person. But you should just be intellectually honest with yourself, and you're actually gambling away your money, so that when you lose it, it's not like an investment gone wrong. It's like sinugal mo and it went the wrong way. So I just want to super highlight that. Now, increasing one's allocation to stocks is very profitable over the long term. As you can imagine, over the short term, because of what COVID did to us, stock prices really got clobbered. But I just want to show you that over the long term, so this is a 30-year chart of the stock market. Despite all the bad things that have been happening through the years, the stock market went from about 600 here in 1991 to about 6,600 as of yesterday. It even hit a high of about near 9,000 prior to COVID 3 years back. And you'll see that essentially, even with the drop of COVID, even with all the negative things happening right now, over 30 years, if you just bought here and then did nothing, your money went up more than 10 times. It actually went out 11 times. And despite Mount Pinatubo erupting in 1991, the Asian financial crisis in 1997, the 2000 dot-com bubble abroad, and the political crisis here, the 2008 US financial crisis, the 2013 taper tantrum in Yolanda, the 2020 Tal eruption, which we thought was already a bad thing. Then you had COVID happening. It was, holy cow, that was a lot worse. So despite all these, you see that your money still steadily went up over time. And that there are times when your money doesn't go up as much. There are times when your money actually falls. But over the long term, you'll see the trend is higher. So it's very difficult to time. So it's actually just best to buy whenever the market falls or in regular intervals to take advantage of this uptrend. So that's your asset allocation. Now let's talk about diversification. If you can really put time into it, I think it pays to actually try and pick stocks, especially if it's your profession. But barring the 0.001% of our population who have the time and expertise to do that, it is better to, maybe buy a diversified basket of blue chips. So I just want to show you for illustrative purposes, when you read the newspaper or on the internet, maybe you guys don't read the newspaper. I still read the newspaper even though it's soft copy, okay? But I still do. You see there's this like PSEI up 1% or 70 points, something like that. That PSEI is what you call the Philippine Stock Exchange Index, and that is not like an index of every stock in the market. The PSEI is composed of 30 of the most liquid and highest quality companies that are currently listed. They're called the blue chips. And what I wanted to show you here is the weight of each index component in the PSEI. So you see that 30 names, very well diversified. You have the SM Group, you have the Ayala Group, you have the Gokongwei Group, you have Ricky Razon, you have the MVP companies, you have the Alfred T companies. You have a holding company, you have malls, you have property, you have banks, you have a port operator, you have a food manufacturer, you have a telecom company, you have Jollibee, a restaurant, you have a power distributor, you have a food and beverage conglomerate with power in it, cigarette and liquor seller, property, grocery, grocery, department store, casino, alcohol, power, etc., etc. So you'll see this index is very well distributed across families, across industries, across sectors, and even by size of company. So, and not only that, these are fairly big, fairly liquid companies. So if you make an investment in here and you need to exit it, especially when your money gets very large, it will be very hard to sell it because they're very liquid and they're very large. So this is an example of how to diversify your portfolio. You don't necessarily have to own all 30. You can actually own more than that. You can own less than that. But it shows you that even if something bad happens to, say, even 5 or 10 of these names, if it's well diversified, you're not going to get hit in a big way because the others will still be okay. Versus, like, say, you own only 3 stocks. That's, God forbid something really bad happens to one of them, like, say, matanggalan ng franchise or gets hit by an earthquake, or things like that, diba? Then that one stock will drag your entire portfolio. But if you have 10, 20, 30 names, then at least your portfolio is relatively insulated in case one of them really goes through a rough spot. So that's my short spiel on diversification. Now, risk tolerance. Um, there are many ways to go about measuring it, but at Philequity, we have a questionnaire to determine, what level of risk you should actually take. And some of us, don't really take the time to like sit down and ask ourselves what type of people we are in terms of taking risks. So it's nice to have a questionnaire. So you like can have a journey of introspection, and when you look at it written, you get to now start to assess how much money I'm willing to bet, how much loss is acceptable to me, how long am I willing to keep my money there, why am I actually putting my money in here in the first place, etc., etc. So this is a screenshot of part of our questionnaire. Now, anecdotally, I hear so many questions from people saying, I can't sleep, I don't know what to do when the market falls, etc., etc. And I'll tell you one story. We had a client one time in one of our briefings back in the day when we could have briefings in Meralco Theater and see each other in person. Someone went to the microphone and said, my portfolio is down 15% and I can't sleep. I'm starting to take sleeping pills because I keep worrying about it, and I haven't had a good night's sleep since the market downturn. This was, I think, 2013 or 2015, somewhere there. And we're like, whoa, 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 taking sleeping pills for that level of stress. I mean, dude, we don't have a client who suddenly ODs and doesn't wake up, right? So we told her, even if we think the market is going to go up, you have to reduce your equity exposure. So this is what we call the sleeping point. You need to know how much you should have in stocks, how much you should have in bonds and cash, such that whatever the move is in the stock market, in the bond market, you can sleep soundly at night. And for some people, that's different. For some people, 10% in stocks, risky na yun. For other people, having 99% in stocks is so comfortable, just right. So you need to know what that level is for you. And it's very important you're self-aware about this so you don't make rash decisions like, okay, market is down 20%, I can't sleep, I'm too stressed, I just sell everything. It turns out you were selling at the bottom. So you have to, so knowing your risk tolerance will help you determine your asset allocation, and therefore, when the market falls a lot, and I think that's when that's more important in terms of trying to make money, you are ready to jump in and buy instead of actually cutting your losses. So you just have to, it's just something that I think all of you should be aware of. So know your risk tolerance, know your sleeping point. Because I'm telling you, if you can't sleep anyway, you're soon going to be so unhealthy that at some point, you'll be spending money on your heart or on your health. Okay, it's not worth it. It's not worth it. So health is wealth, especially in a time like this. That's becoming like really top of mind. So know your sleeping point. And then finally, time horizon. This is cliche, but again, I have to repeat this. Especially, I think most of you are beginners or moderate knowledge. Time in the market is more important than timing the market. The amount of time your money stays invested is more important than trying to catch the low and buy and catch the top and sell. Because unless you have a crystal ball and you can do that perfectly, or you're like the god of traders, going in and out may actually cause you to lose money, or you may actually do worse than the actual stock market performance. Now, a longer time horizon will also allow you to participate in the country's growth. So you know that the Philippines net over time, the economic growth is going to be positive. So the longer you stay invested, the longer you can participate in our country's upward trajectory. And not only that, if your time horizon is long, you will be able to withstand the volatility. And in fact, you may actually use those drawdowns, those corrections to actually increase your exposure. And I know timing is something that's very hard to do, so you can just do peso cost averaging, just like buy every month. Now, the reason you can have a long time horizon is if your money is not money you will need in the short or medium term. So when you invest in the stock market, understand that this is a long-term investment and therefore this is long-term money. This has to be extra money, money that you don't need, okay? And this is money that if hypothetically you lose it all, will not change your lifestyle. So when I hear people saying, I'm gonna get married next year, I'm going to invest my wedding budget now while I haven't paid for it. No, you do not do that because baka ibig ikasal kayo sa church, baka na lang sa your wedding from like 500 guests might become like 10 guests if the market goes down, right? So, or like, this is my budget for building a house or buying a condo. I'm gonna invest it before I actually pay the final tranche of payment. No, 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 don't do that, okay? This should be money you do not need. This is money that was not earmarked for something else. So again, only excess money, because if you do not invest excess money. Or worse, if you actually borrow money to invest, your psychology will be very, very different when the stock market falls. Okay? Trust me, you'll end up selling at the wrong time, and you do not want to do that. You might end up selling when you should actually be buying. So again, set aside your long-term money. That is what you put in the stock market. So to summarize, if you want to have a healthy portfolio that will generate returns for you over time, these are the four main factors. One, asset allocation. Two, diversification. Three, risk tolerance. And finally, time horizon. So these four factors are what you should consider when you construct your portfolio. Now, I know not everyone has bought stocks in this audience. Some of you probably never even buy stocks, or it's too hard to understand, it's too complicated. Every time I buy stocks, I lose money. I'm not an expert. I only want to do things I'm good at. Buying stocks is like gambling. Well, to be fair, some stocks are like going to a casino, but not all of them, just some of them. Or that I don't have the time to actually invest. There's nothing wrong with this. Actually, this is partially true actually for some people. So we understand that some of you may not want to buy stocks even though you actually want to participate in the stock market in some way. And if you want to profit from the bull market in Philippine stocks but have neither the time nor inclination to buy stocks directly, just buy an equity mutual fund. Or if you want to buy a bond mutual fund, you can also do that. Like if you don't want to choose yourself, just buy a mutual fund. So basically, a mutual fund pulls together money from different investors, is invested in different stocks or bonds, depending on the mandate of the mutual fund. And the value of your shares in the fund change depending on the movement of the underlying stocks. And all of these will be managed by a professional fund manager like Mr. Wilson C. or me. Now, I want to highlight this is not like pyramiding, okay? So please stay away from that. Madaming ganyan na, okay, we will pay you 20% interest a month, okay? Rule of thumb, if it's too good to be true, it's probably not, okay? So really just be careful of those gifts, because I think with COVID right now, ang dami ng bagong fraudster and con artists doing it online. So just be careful. Okay. Philequity Management Inc., we have different mutual funds. We have a number of equity funds. I'll just breeze through this. I want to end my presentation in about 5 minutes so we can go to Q&A. And we have a couple of bond funds. So the bond funds, I'd say, are the most conservative and defensive of our funds. So these ones, as I will show you, over time, you see very rarely does the value actually go down. When over 20 years, your money triples. So it's like not like a very high return, but it's like, how do you say, at least a very relatively low risk return. We have a dollar version of that, and you'll see that over time, it's up up 2.5 times, but this excludes the impact of the peso. So it's actually up a bit more than that. So your next less risky is the Philequity Index Fund. So we have two types of index funds. The PSE Index Fund is a fund that basically copies the 30-member PSEI I actually showed you earlier. So all the local funds in the Philippines, this is their benchmark, the plain vanilla PSE Index Fund. So if you want to do stocks, you're a beginner, want to do a mutual fund, you can start this way. Not much pizzazz, vanilla, boring, but very reliable. So that's its return over time. Now, when foreign funds buy in our market, they actually compare their performance against a different type of index, which is why we wanted to offer that to our investors, to our clients as well, because they don't follow the PSEI. What they follow is the MSCI Philippines Index, which is similar to the PSEI in a way, but it has less members, the weights are different. So also the returns would be different. So we had this fund, of course, because of COVID, it's not doing too well. But again, if you want to follow what the foreign funds are buying, this is the fund we have. So this is what the foreign track. Next, we have a dividend yield fund. So this fund, basically, when it increases, it has higher weight in stocks that pay high dividends. So you can imagine, because it's more defensive, when the market goes up, it goes up less. But when the market goes down, because the stocks pay a lot of dividends, this fund also falls less. So you'll see in its top holding, you have PLDT, Meralco, and Globe, which pay a lot of dividends. So this one actually is doing better than the market this year because our index is down about 10%. So doing pretty well. Okay, of all our mutual funds, okay, this is the single riskiest mutual fund. So only if you're like, I want to go equities and I want to go the maximum risk mutual fund, this is the one you go for, okay? But only if you're like maximum risk for maximum return. So this is our Alpha 1 fund. This one, basically, this one is like, maximum return. I won't follow the index. I can put 20% in one stock, 30%. I can go 30% cash. I can only have 10 members. So this one, I wouldn't say YOLO, but the rules are a bit different. But you'll see that risk is rewarded by return. So in red, you'll see the return of the PSEI, and in yellow is the Alpha 1 fund. In fact, last year when the index was down, the Alpha 1 ended the year in the green. And this year, it is still it's down a bit, but it's still outperforming the PSEI. Then finally, you have our flagship mutual fund, the biggest, the oldest, the most reliable of all our funds, the Philequity Fund. So this one, this has been managed by Mr. Wilson C. since 1994. You see, if you had 100,000 invested in 1994, one shot, you never added, you never sold, nothing, that 100,000 would be worth more than 3 million today. And the reason it's worth so much is because it outperformed the market significantly. This is the return of the Philequity Fund over 27 years. And in 27 years, it outperformed the market in 21 of those years. Net of fees, so this is already net to you. So for example, in the 1997 financial crisis, when the market fell 41% in 97, the Philequity Fund only lost 5%. In the year 2000 to 2002, when the market lost more than half of its value, the Philequity Fund was still up about 3% over those 3 years. In 07, 08, 09, when the market tanked, natamaan yung Philequity, but among the mutual funds, Philequity was the first mutual fund to make back, in the industry, to make back the losses of 2007 to 2008. So the track record is clear. I don't think you can see another fund with this long and this reliable a track record. So these are just your returns year to date. These are some fun features which the other members of the team can talk about with you. I also want to show you, you can talk about this later if you guys are curious about cost averaging, but you'll see that if you just schedule your buying over time, you may actually be able to catch certain down moves where you can get stocks very cheap instead of just buying one shot. And in fact, if you bought one shot, the same amount of money, I think 16,000 pesos, you would own 500 shares of Philequity, 501 shares. But if you bought at 16,000 over a 4, 5, 6, 7, 8, 9, 12 1-year time period, um, yeah, I'm sorry. If you bought one shot, you'd only be able to buy 484 shares. But if you bought over a 1-year time period, you would actually have 501 shares of Philequity instead. And this is using the same peso amount of money. So that's why peso cost averaging, like you don't really know when the market will go up or down. But what you can do, you can just buy every month. So you can take advantage of the volatility. And you can actually automate this, I think, via BPI or BDO. Again, you can contact the other members of the team to help you regarding that. So, you know, it's very hard to find a fund that can perform like this. That's why I said it really pays. Like if you want to invest in the stock market, you can start in a mutual fund first. And it's very important to invest in a mutual fund where, you know, we just put the returns right here so you can see with no benefit of hindsight, a fairly consistent return versus the market. So, you know, to end this presentation, if you want to participate in the growth of the Philippine stock market, but you have neither the time nor the inclination, if it's too stressful for you, if it's too hard, if it's too scary, and you want to make money without really working hard for it, just give it to Philequity and then we'll worry about your money for you. So again, stay safe. Thank you very much and have a good afternoon.
Okay, very important lesson from our guest speaker, Mr. Miguel Agarao. Thank you very much for sharing your Friday afternoon with us. And with that, I would like to invite everyone to join our online community. We are on Facebook, Instagram, YouTube, and Twitter. If you need to get in touch with my team, the Market Education Department, our email address is academy@pse.com.ph. Visit the PSE website for all the corporate information you need. It's www.pse.com.ph. For corporate disclosures, edge.pse.com.ph. We also have investing materials in our Academy website. That's www.pseacademy.com.ph. Download the PSE Edge mobile app for the latest disclosures at your fingertips, and the PSE Easy mobile app for whenever there's an IPO, you're ready to subscribe. And speaking of subscribe, please subscribe to our YouTube channel. So we have the recorded webinars and videos there. So I think we have over 40 materials already, and we are posting new materials almost every week. And of course, our recorded webinars are also in YouTube, in Facebook. Click the subscribe button so that whenever we go live, you get notified. So we will post our announcements in the coming weeks for our lineup of webinar topics for the second quarter of 2021. So until then, I'll see you all again next time.